Hi, welcome to this podcast where I'm going to be looking at standard costing and I'm going to introduce the concept of sub-variances, hence submarine. Right, I think the first bit of this is relatively straightforward, so hopefully if you followed all my videos through, if we want to work out a budgeted cost, we multiply the standard quantity, and that's how much raw material we need to manufacture a particular quantity that we're budgeting on quantity, and multiply it by the price. So here, to make whatever the output we require is, we need 10,000 kilograms. We're expecting it to cost $10, and therefore our budgeted cost was $100,000. And the next bit's also pretty straightforward because we know our actual quantity, that's the total amount of kilograms of raw material we used to make our output. And we know the actual price. So if we multiply the two together, we get an answer. And again, if you've hopefully watched the video that I've already done on favourable and adverse, that would be a favourable variance because overall the cost of material has decreased from $100,000 to $99,000. Pretty straightforward stuff. It's favourable because it's positive for profit. The profit is going to increase because our costs have decreased. Okay, not massively difficult. There's a problem though here because there's two elements to our variances. We've got an adverse bit because our production team have used 1,000 kilograms more than was planned. And the reason why it's favourable is because our purchasing department appear to have got the price of the raw materials down from $10 a kilogram down to $9. So overall on the business, the impact has been favourable. So what we would like to be able to do as people that are really trying to help draw a business forward, which is what accountants should be, they're working in industry, and what we should be is trying to identify how positive the increase or the decrease in the purchase price has been, and also how negative the increase in the amount of material used has been. And we do this by sort of putting an interim stage into the calculation. I'll show you to do it just using a formula. You will need to learn the formulas because sometimes exams ask you to do this. But what we do is the first stage, we're going to look at the actual quantity of raw materials used, but then keep the price as with the original purchase price in the budget. So we've used 11,000 kilograms. If we'd used them at the budget price, then the total cost of buying the raw materials would have been $110,000. And we say that that's an adverse material usage variance. Okay, the amount of this total of 1,000 of favourable variance that's due to the fact the production department have used significantly more raw materials than planned is 10,000, and it's adverse. So actual quantity times standard price gave me the 110,000. And then if we compare that figure with the original 99,000 for the actual total cost of the raw materials, well, there we can see that there's a decrease from 110,000 down to 99,000. So the material price variance, the difference due to the price, is actually 11,000 favourable, and the overall difference is it's 1,000. I was going to say 11,000 then, but it's 1,000 favourable. Now, for some of you this is fortunate, for some it's unfortunate. What you are going to need to do is to learn some formula for doing this. Material usage variance is the actual quantity minus the standard quantity times by the standard price. Okay, 11,000 minus 10,000 multiplied by the original 10,000 price, and that gives you a 10,000 adverse variance. It's adverse because the actual quantity is greater than the standard quantity, and the material price variance, okay, that's your actual price minus your standard price multiplied by the actual quantity, and that gives you 9 actual price, take away 10 standard price, multiplied by 11,000, the actual quantity comes to a 11,000 favourable variance, and it's favourable because the actual price is less than the standard price. Be a little bit careful. It's not wrong to do the bits and brackets the other way around. You'll see it both ways in textbooks. I've chosen to write the formula out this way because normally this is the way that it appears in the mark schemes for Edexcel. I know in other boards it sometimes appears as standard quantity minus actual quantity times standard price, and standard price minus actual price times actual quantity. And that's why I've sort of put here this note. The key thing is if your actual quantity is greater than, or actual price is greater than your standard quantity or standard price, then it's going to be adverse, and vice versa. If your actuals are less than your standards, then it's going to be favourable. Okay, some questions here for my students to do and email back to me. So if you're doing the questions, might be an idea to pause the video now, and then there is a little bit of theory just to follow. Okay, a little bit of theory just to follow is common exam questions to ask you to explain possible interrelationships between these subvariances. This is the first video. The other video will cover labour rate and labour efficiency variances. Okay, but what we're looking at, for example, is where we change one factor, e.g. the labour rate, we pay people less and we get lower quality workers. And this may have an impact on more than one subvariance. So if we reduce the labour rate, we may either have less motivated or less capable workers. And what that can do, it can increase the time per unit, so we get an adverse labour efficiency variance or subvariance. It can increase the scrap. They're not as capable of doing the job, and therefore there's more scrap produced. And that would have an adverse effect on the material usage subvariance. Okay, and it will also decrease the labour rate, and that will be favourable for the labour rate subvariance. And what we can do, if we've got that idea that changing one thing can change other things, if we've deliberately decided to reduce the labour rates, we can then review that decision in light of the fact that we know that there's going to be 3 subvariants affected, and we can look and see how large the overall effect is on the business. If the adverse labour efficiency subvariance and the material usage subvariance were greater than the labour rate subvariance, then it would overall be a positive thing for the business. And vice versa, if the labour efficiency and material usage subvariances were greater than the impact on the labour rate subvariance, then we would probably see it as a negative thing. So doing this helps managers investigate causes of subvariances. What are the possible reasons why my labour rate subvariance is positive or negative? And it also helps identify the overall effectiveness of changes on a business performance. Okay, right, thanks very much for listening. Have a great day. And my students, obviously, As I always say, email me if you don't understand anything. Thanks a lot. Bye bye.